Kumar Karwa joins us, Managing Director with Emkay Global Financial Services. Let's connect with him to understand his market outlook and what is he telling his clients to do in this kind of environment. KK, good morning. Thank you for joining us. KK, for someone who's active in the market or is invested in the market, this is perhaps one of the strongest patches we've seen in last 20 years. My question is that do you think the party is here to stay or now it's time to get worried?
Good morning, Nikunj, and thank you for inviting me on your show. Yes, so we have an interesting question when the markets have run up so aggressively and the breadth of the market being what it is. Right? How do you play the market going forward? So I am of the strong belief that at any point of time, there are always opportunities to be invested in, to invest fresh or to stay invested. I think it is all about being very, very focused on bottoms up in terms of the opportunity of this that one stock offers and the valuation at which you are buying. Now, on a general broad basis, if you will ask me, then possibly many of the stocks in the broad market have run ahead of their time, and possibly the returns now, if you invest fresh, would possibly be on the back ended. So it's very important that investors are very, very cautious as far as putting fresh money into the market. But having said that, there are many opportunities. So I think it's a time to reshuffle your portfolio, book out stocks where you think possibly FY23, maybe FY24 is getting discounted. And at the same time, invest into companies where you believe that the valuations are attractive and the opportunities are there. And this time around, because of the participation of the retail investors who now account for almost 45-50% of the volumes traded, and even if you look at in the March quarter, they are now inched up to 9% of the overall holdings. So I think the breadth of the market is there to stay. It's not going to be a narrow market the way it was in the last 5-7 years. So if you are very strictly on bottom-up basis, then there are opportunities to invest in. So I don't know whether I've answered your question directly, but idea is to stay invested, but be very, very careful on the portfolio.
So where are the opportunities in the market where you would say that it's time to still stay invested, and whether it is earnings or valuations or a combination of both, they both are inside of a long-term investor. They both are favorable.
So to start with, I think in the whole public sector space, there seems to be a lot of opportunity. Some of it has got unlocked in the last 6 months, but still I think going forward. And I know most institutional investors don't like to invest in public sector units for various obvious reasons. And even I have been skeptical for long. But I think this time around, maybe for the next few years perspective, if a divestment takes place, then obviously the whole story changes. So my sense is that there could be a lot of value unlocking in public sector manufacturing units. Also some of the public sector banks, we have seen that they have cleaned up their act in terms of their asset qualities. I think market is willing to give them the necessary capital. And if the economy is expected to do well, then I'm sure they would also be able to see a decent uptick in their credit disposals, etc. Valuations of many of these public sector banks are attractive. And as rumored, if there are some banks which are put up for sale for privatization, then that adds one more leg to the whole public sector banks also. So I think that is one space which looks very, very attractive to invest in. Second space, which I still believe has a lot of legs, is the real estate sector. That sector has been in the doldrum over a 7-8 year period. A lot of consolidation has happened. Only brands or companies with strong balance sheets, strong managements, they are able to attract residential investors or other people who want to buy homes. So I think that sector has still a lot of legs, and there you will have to be very, very region specific. So you can possibly invest in a few major across region, be it South India, be it Mumbai, or be it the NCR region. So that is another sector which I believe still offers a lot of opportunity. Third, I believe the Capex cycle is on. As far as if you speak to corporate India, many of them have put in a lot of Capexes or rather are contemplating and upgiving orders, etc. So my judgment is we have already seen the uptick in steel, cement, but I think you need to go down the chain, and possibly there is a lot of opportunity in the smaller mid-size companies which have been in the doldrums for want of orders. I think their position seems to be improving. So that could be another opportunity to invest in.
How much of the optimism in PSU is purely a function of the fact that one day or someday or eventually, I'm using the words again, one day, someday, eventually BPCL would be sold and that will re-rate the sector?
No, I don't think so. That is the only reason for one to invest in the public sector. It is an important reason, as you say, that yes, that could further give a uptick to the overall sentiment for the sector. But I think you will have to look at the various businesses that many of these companies are in and the valuations. And that itself makes them an attractive play. Also, I think investors, as I said earlier also, that investors have broadened their horizon. I think it's not as narrow where maybe a few years ago it was growth, investing in growth at whatever valuations. I think the retail investors have taken a bigger chunk of the volumes. So I think they are becoming much more broad-based, and they are the ones who are possibly driving the investments which are happening in such value opportunities. So my sense is that, yes, a BPCL divestment will lead to a further re-rating, but a delay in BPCL divestment should not impact adversely the valuations of many of the other public sector companies. We have seen some of these power utilities, the way they have got re-rated over the last 6-9 months. Now, there is no question of any divestment happening over there, but the sheer valuations of many of these companies, and investors have recognized that, and they have invested, and we have seen the price uptick which is happening.
Okay, I'm curious, Krishna, between the kind of divestment that's lined up and then the big bang IPOs that are coming up as well, how much appetite do you feel there's going to be in the market for some of these IPOs slated later in the year? Do you think the markets will be able to absorb it, in the sense we've got a 3 billion Nykaa IPO, 4 billion Paytm IPO, or around those numbers, just to name a couple. What's your sense on that? I mean, regardless of whether or not you're looking at investing, how do you feel the markets will respond to this amount of paper coming in?
Honestly speaking, that is my biggest worry, because we have always seen that the euphoria in our domestic markets for various reasons, if you go back in history and see, I think finally the top is called when you have a huge spurt of fresh issuances, and that sucks away the liquidity or the appetite of local and global investors. And one marquee IPO not being successful or having a poor listing, etc., and the whole sentiment changes, apart from various other factors. So honestly speaking, that's my biggest worry, is the flood of IPOs which are hitting the market in the next 2, 3, 4 months. And the valuations, many of these IPOs are something which are new to the Indian capital market in terms of how to value some of these companies. There is a lot of appetite from institutional investors for such kind of companies. So hopefully they should get subscribed, but the subsequent listing and how they behave, that would be very, very important to track. So if you ask me, what am I being cautious about? I'm being cautious about the flood of IPOs which are expected to hit the market, and some of them with business models which Indian investors possibly don't understand or appreciate.
Absolutely. I'm glad we brought that up and got your view there. Talking about perhaps then where one should look for opportunity, are you going by the recovery theme and the cyclicals, which is really what everyone seems to be continuing to focus on, or do you feel perhaps it's more prudent to continue to have a mix right now, given that things may still be a little uncertain for the next few months?
I think every season there are some flavor, in terms of, okay, sometimes it could be an unlocked trade, sometimes it could be global recovery, sometimes it could be some government announcements, and based on that, I don't think so on a sustainable basis you can manage portfolios by trying to chase themes. And that could be from a short-term trading perspective. But from a longer-term perspective, it is all about having a very, very balanced portfolio, where I think it's more about the individual companies that you invest in and the opportunities that they offer. So having said that, my sense is that a very balanced portfolio should do very well. Investors should not be chasing the unlocked trade, because I think this time around, the recovery is not going to be as V-shaped as it was the last time around. I think investors are focusing or believing that the same kind of recovery will happen in the companies. Because rural India has got massively impacted, possibly the recovery will be much slower. The system also in terms of is very well last time around, because there was a lot of, the first quarter, there was virtually no manufacturing, etc. So there was a huge amount of pent-up demand. In the last few months, no doubt, across the country, there has been lockdowns, but there has been a lot of measured opening up also. So businesses were able to continue. So there is no expectations of any pent-up demand kind of an atmosphere. I think investors are probably overshooting on the unlocked trade. That's my sense. Having said that, yes, am I bullish on the market? Yes. Am I bullish on consumer durables? Am I bullish on autos? Yes. But my sense is that the recovery would be slower than normal. That's my initial take.
I'm scanning through what is happening in the market right now, and today is just one of those days where things are getting slightly lazy, if I may use the word. KK, everybody is excited about this entire vaccine business or the vaccine opportunity which is getting created. Some are buying vaccine manufacturers, some are buying cold chain companies, some are buying companies like Shilpa and Wockhardt, which have capability to, in a sense, put a vaccine together if they have the license or if they have the approval to manufacture them. This is going to be a multi-billion-dollar industry. What is the best way investors can participate in it?
So my sense is that, yes, there is this opportunity which, as you alluded to, in terms of the various companies who will be manufacturing those vaccines. But if there is an opportunity, then there is going to be a huge competition also. So yes, one time there could be a massive cash flow generation for many of these pharma companies. But then I think over a period of time, it will peter off. So investors should be very, very careful as far as valuing this opportunity. It's a one-time opportunity. That's the initial take that I would look at it. How companies use that cash flow generated over the next 12, 24 months, that will determine the valuations of many of these pharma companies who will benefit out of this opportunity. After that, I think things will normalize. That's the take I would have. So I would not be looking to invest in any company just basis the opportunity that this one-time vaccine opportunity offers. So as I alluded to earlier also, is that portfolio investing is not about what's the flavor of the season. I think if you will do that, possibly you will end up buying wrong stocks at wrong valuations. It's more about the sustainable opportunity that investors should be looking at. And whether this vaccination is a one-time opportunity or a sustainable opportunity, I don't think so we are clear about it.
Is the optimism in some of the steel stocks slightly overdone? The manufacturers are telling me that, look, India needs more steel and there is no supply, so demand will remain strong. If I look at global data points which are coming from China, they're telling me a different story, where the Chinese authorities are worried about escalation in metal prices. What is the right way to look at steel, or even for that matter, non-ferrous stocks?
Yeah, I think in commodity stocks, the maximum money is made when everybody is skeptical. Today, it's the other way around, where everybody is extremely positive. And honestly speaking, as far as management of commodity companies are concerned, they are in their business, so they have to be optimistic, they have to be positive about their businesses. But in terms of demand dynamics and where will supply come from, I don't think so we ever get the right answers from the management. So I think it's an independent assessment that one has to make. But having said that, the beauty this time around is that the kind of balance sheet cleaning up which has happened, which means that many of the companies who have benefited from this cycle, the kind of debt reduction that many of these companies are witnessing, that is something to be very positive about. So my sense is that the overall valuations of many of these commodity companies will settle at a far higher level at the end of the cycle than normally we have seen. A lot of consolidation has happened in the local, in India. Many of the steel companies have been taken over by existing steel companies, etc. So the valuation multiple, where they will settle afterwards, like after the cycle, would be on a much higher side. So having said that, am I an investor or recommending investing in many of these metal companies now? I am a bit iffy about it because I think the maximum juice has been made. Yes, these companies will continue to do well for the next few years. The question is whether investors will give them a higher multiple. That is the question one has to answer. Or as as investors start expecting the valuation multiples to contract, maybe earnings will grow, but the valuations or the absolute value of these companies may not grow up. So I'm being very conservative in my assessment of the commodity or rather these global and local commodity companies.
KK, if to, let's say, dissect the portfolio into time frames, where do you see a tactical trade for next 6 to 12 months, and where do you see a slightly more cyclical and a structural trade for next 3 years? How would you bracket stocks and companies in these two buckets?
So if I have to play a next 3-year kind of a trade, and so then my sense is that your financials and your real estate companies, they are offering you a very good opportunity from a 3-year perspective. That's where I believe that maximum money will be made. But from a 1-year tactical perspective, if you want to play, then I think you should be looking to play some of the global plays, which means companies which are focused on, which have overseas businesses, overseas exposure, some of the auto ancillaries or some of the auto majors which have maximum exposure. Because I think the next 1 year, I think the global recovery is going to be very, very sharp. And so from a 1-year perspective, it makes sense to be playing those trades. Maybe our domestic recovery could be slightly slower than normal. And maybe so that's why I would recommend domestic recovery plays should be on a slightly longer term perspective, and a global recovery place should be on a tactical 1-year perspective, as you asked.
Sure. So Krishna, if someone were to come to you and ask you how is it that one can get rich in the next 1 to 2 years, what would you advise him?
I think he's in the wrong business if he's coming to become rich in the next 1 to 2 years. I think our markets are all about a long-term compounding. And I don't think so the 1-year, 2-year perspectives are going to work. So if he's looking at that kind of this thing, then might as well not come here. I'm very sorry to answer this question the way I have answered it, but the fact remains that it's very difficult to make money in the short term. It's all about long term, and I'm sure you would understand that.
Yeah, absolutely. What about the patient ones then? Those who are willing to wait it out for 10, 15 years? If they were to ask you, what is that one stock that one can invest in and forget for the next 10 years and generate sizable wealth, which stock would you pick out?
Yeah, honestly speaking, we are not allowed to talk stocks, so I would not be able to recommend a stock to you. But some of the consistent compounders, if you can say, which have delivered returns over cycles, and where the price correction or the mark-to-market losses are not very high over a longer time frame. So there, I think obviously the steady stocks would be the consumers, would possibly also be the IT companies for their strong cash generation that they do and the payouts that they do. If you're looking for a long-term compounding opportunities, then I think it would be in these two sectors where, because of the sheer quality of balance sheets and the opportunity that they address, and these companies have continuously kept on evolving with the changing times. So any top 2-3 companies that you pick up from these two sectors, and they should deliver to you very good compounding returns over a longer time frame. I think the expectations also should be rightly tempered with. You should be looking at what's the risk-free rate of return, and then what is the kind of risk premium you would want to earn. And if your expectations are fair, then I'm sure you would be able to make decent returns in some of these sectors that I mentioned about.
Fantastic. Thanks for joining us this morning, KK. Always great chatting with you in depth about some of the current, trends in the market.